If you're a high-income earner, doctor, lawyer, or business owner making $300,000, $500,000, maybe even $1 million a year, most of the real estate advice out there isn't made for you. Instead, it's built for someone making $70,000 a year, trying to buy one rental at a time, maybe save a little on taxes. That might work for them, but it doesn't work for someone making multiple six figures a year. You need a different strategy. When my wife and I first started investing together, we were both working as doctors making $600,000 a year. We were making great money, but we quickly realized that the strategies people were pushing didn't apply to us. In this video, I'm going to break down exactly why the real estate advice out there doesn't apply to high-income earners and what you should be doing instead if you want to accelerate your path to freedom. Let's be honest, most real estate advice out there is built for the average investor. They're trying to figure out how to qualify for a loan, how to buy with bad credit, how to save $10,000 for a down payment. But if you're a high-income earner watching this, those aren't your problems. You already have great credit. You're earning multiple six figures. You can save for a down payment without cutting back on groceries. Your challenges are different and bigger, literally. You need strategies that actually make a difference. You need to generate a lot of cash flow to even make a dent in your income. You need to create a big tax shelter to offset your high income, and you need a strategy that justifies the effort. This is a really important point, so I'm going to emphasize it again. You need to make sure that the time you put into building a real estate portfolio is worth your time and you get paid a high hourly rate. This requires a completely different approach, which we'll get to in a minute. But before we do, I want to cover some strategies you'll see online and explain why these strategies won't work for a high-income earner. The first one is a popular strategy called just buy one rental a year. It sounds simple. Buy one rental property every year, and over time, your rental income will grow. You'll slowly build equity in those properties as you pay down the loan. And with each property, you'll get closer and closer to financial freedom. But here's the problem. If you're a high-income earner, this strategy is usually too slow, and the amount of money these properties generate is too small to matter. Let me give you a real example. We had a doctor reach out to us and tell us, I've been buying one property every year for the last 4 years. A single-family home, 2 duplexes, and a fourplex. A total of 9 doors. I make about $2,000 to $3,000 a month in cash flow, but it doesn't feel like I'm moving closer to financial independence. This is someone who followed the buy one property a year playbook. He took action and still ended up stuck. Because here's the truth, if you're earning $600,000 a year, an extra $30,000 in cash flow a year doesn't change your life. It doesn't give you leverage, and it doesn't buy back your time. Later in this video, I'll show you what he should have done instead and how you can avoid the same mistake. The next strategy you'll see out there is one that's heavily marketed to high-income earners, turnkey properties. The pitch goes like this. You're busy, you don't have time, let us do everything, we'll find the property, renovate it, place the tenant, and you just collect passive income. It speaks directly to your biggest pain point, time. And on the surface, it sounds ideal, but here's the problem. First, you're paying retail prices, and when you pay retail, you give up one of the biggest wealth building tools in real estate, forced appreciation. That's how my wife and I built most of our wealth. We bought right, added value, and unlocked equity we could use to scale. With Turnkey, you miss out on all that. Second, the cash flow is average at best. If I had to grade it, I'd give it a C. And let's be honest, when was the last time you were okay with a C? Most of you didn't settle for average in school or in your careers, so why would you settle for it in your investments? And finally, you don't learn how to operate the business. You think you're saving time, but what you're actually doing is outsourcing all the value creation, and all you're left with are the headaches. You're buying an asset you don't understand, don't know how to improve, and in a location you have no clue about. And that can leave you owning a poorly run business for 10, 15, or even 20 years, one that's underperforming and doing very little for you financially. So ask yourself, would you run a business for 2 decades that underperforms? Is that really worth your time? Or would you rather learn a few key skills and build something that actually grows, cash flow, and gets better every year? Because once you know how to operate your investments like a business and take control of the value, everything changes. Let's dive into the third strategy you'll commonly see online, and this one definitely doesn't work for high-income earners, and I'll show you the numbers to prove it. This one is called aim for $100 to $200 per door in monthly cash flow. If you're new to real estate, each door is a separate residential unit, complete with a living space, kitchen, and a bathroom. So a duplex has 2 doors, which means it has 2 separate living spaces. So let's run through the numbers for a duplex and see how this strategy plays out. Let's assume you buy a $200,000 duplex and each door generates $200 per door in cash flow each month. That's $400 a month or $4,800 a year. If you're earning $70,000 a year, that $4,800 might actually feel meaningful. But if you're earning $500,000 a year, that cash flow isn't even close to moving the needle. especially when you consider the time and energy required to get it. Now let's look at the tax side. That same $200,000 duplex might allow you to create around $50,000 in paper losses through depreciation. That's great if you're making $70,000, but again, if you're earning $500,000, that $50,000 write-off barely dents your tax bill, and in many cases, you won't even be allowed to use it. Here's why. Most of the tax strategies being taught in real estate assume you make less than $150,000 per year, because under that income level, you can use the losses from your rentals to offset your W-2 income even without any special tax status. But once your income goes over $100,000, those benefits begin to phase out. And once you hit $150,000, they're gone, unless you qualify as a real estate professional. So let's recap. You're getting cash flow that's too little to matter, tax benefits you can't use, and you're following a strategy that was never built for someone in your tax bracket. And that's what most people miss. Once your income hits a certain level, you're playing by a completely different set of rules. And if you keep following advice built for someone making $70,000 a year, you'll end up spinning your wheels and wasting your time on strategies that just don't work for you. So what does work? You need properties that produce meaningful cash flow, that create tax benefits big enough to make a difference, and that help you scale and grow your real estate portfolio faster. Let me give you an example from our portfolio. We started with 3 small properties, but instead of turnkey, we bought them at a discount and we created value through forced appreciation. And what happened? With these moves, we were able to increase the equity in those small properties to $850,000. We then rolled that equity into a $3 million 32-unit property. This 32-unit generates 6 figures in cash flow each year, and it sheltered $850,000 of our W-2 income through cost segregation and bonus depreciation. That's what it looks like to use real estate to build wealth, not just a side hustle. And it's not just us. You can learn how to do this too. We have training programs focused on the needs of high-income earners, and many go out and scale their real estate portfolios quickly to 20, 30, and even over 100 units in a couple of years. And more important than the number of units, they generate hundreds of thousands of dollars in cash flow per year and shelter their high salaries with real estate. They did it by following a plan that fits their income level and goals. And in a minute, I'm going to cover the mindset shift that makes that possible and how to apply it in your own journey. Here's the thing, scaling isn't actually hard, but it does involve a lot of new things, new strategies, new terminology, new ways of thinking. And where you're used to operating in a space where you're confident and competent, stepping into something unfamiliar can feel overwhelming. That's where a lot of high-income earners get stuck. Buying one small property a year feels comfortable. Turnkey feels convenient, but neither approach is aligned with your income level or your needs. And that sense of overwhelm, that fear of making a mistake or wasting time and capital, that's real. We see it all the time. That's why having the right mentor matters so much. Someone who can help you push through the uncertainty, build confidence quickly, and actually accelerate your progress instead of stalling out. Because once you learn how to scale, how to evaluate bigger deals, how to use equity in partnerships, how to create real cash flow and shelter income, things change. And in just a moment, I'll show you how your environment plays a massive role in whether you scale or stall. You've heard the saying, you are the average of the 5 people you spend the most time with. If everyone around you is talking about $200 a month in cash flow and 1 rental every few years, that becomes your ceiling. But when you're surrounded by people going out and buying 20, 50, and even 100 units, everything shifts. You stop thinking in terms of safe or small and start thinking bigger. So here's the point of this video. If you're a high-income earner, you need a different real estate strategy. The slow growth models being pushed on YouTube and social media weren't built for the amount of money you make or your tax bracket. So don't waste your time, capital, or energy following advice that doesn't serve you. There's a smarter way to do this, and it starts with understanding how to scale, how to create value, and how to play the game at your level. If this video hit home for you, I'd appreciate it if you hit the like button and subscribe to this channel. Also drop a comment. I'd love to know where you are in your real estate investing journey. If you're ready to start investing with a strategy built for high-income earners, check the link in the description. That's where you'll find how we help high-income earners like you to scale up your portfolios quickly and strategically. Thanks for watching, and I'll see you in the next one.